Hello from Trendsignal for a review of the data and events the week beginning the 19th of August. It follows on from last week's turbulent markets with a surprisingly poor data from China and Germany. GDP data, the prelim reading for Q2 coming in at minus 0.1%, which on the back of fourth quarter last year, which was negative, first quarter just positive, and then negative again. It's highly likely that Germany is in actually a technical recession now, because Q3 is likely to have a pretty bad outcome when it is finally announced in 3 months' time. Certainly, some of the manufacturing and purchasing managers' data is looking quite negative, as you can see on the screen here. Last week, markets very, very turbulent. Just looking at some of the indices, have a quick look at the S&P 500. You can see this volatility, some extreme moves. Last Wednesday, when the Chinese industrial production data was announced, followed by the poor prelim second quarter GDP number from Germany, really sparked fears that the global economy would be weakening further, if not going into a recession. And that sparked what was a fairly dramatic fall on certainly on the Standard and Poor's. S&P 500 falling from 2930 all the way down to 2836, so a good 90 points fall. Obviously, since then, Thursday, Friday last week, and on Monday morning, while I'm talking, the markets have recovered a lot of those falls. But it's all on the hope, all on the expectation that central bankers are going to come to the rescue of the markets. And that's what it's all about this week. We have probably the most important event is the minutes from the previous FOMC meeting at the end of July, the 30th of July, when the Federal Reserve cut rates. Although the market didn't like what Jay Powell, the chairman of the Federal Reserve, gave the reason for cutting rates, i.e., it was a mid-cycle adjustment rather than any longer-term easing cycle. But that may still change. The markets had cooled on their rate expectations, but I think in light of these sort of moves last week, there is still an expectation that rates are going to be cut. And if we look at the CME's um, interest rate contracts that predict what the rates are going to be on certain dates, it's very clear that there's a almost unanimous view that rates are going to be cut by 25 basis points on the 18th of September meeting. October, another cut to 150 to 175 basis points, so 71% predicted there. Then on the 11th of December, the final meeting of the year, it's a little bit mixed. 44% still predicting a rate cut, which would be the third rate cut following on from the rate cut last month. So in total, 4 rate cuts. I think it's unlikely. I think it's likely that we're going to get 2 rate cuts by the end of the year. But it all depends. It depends on lots of things, of course. But for now, certainly central bankers are expected to come to the rescue of the markets. And it was quite a chilling move last week. Here, the yields on the main 10-year government bonds, global government 10-year bonds, and you can see that there's a lot of negatives in total now. According to the Financial Times, $16 trillion worth of sovereign bonds are now negative yielding. Some countries only have negative yielding bonds all the way across the curve. Last week we hit milestones in the UK and in the US where the 10-year yield went below the 2-year yield. So that's effectively what's referred to as an inverted yield curve. And the last time that happened in the US was in 2008. And the last time it happened in the UK was 2007. So, and we know what happened after that. So it's a worry to the markets. And you might say, well, why are the markets not going down? Why are the markets recovering over the last 3 days? This is the S&P 500 again. The fact of the matter is, with yields negative, for example, if we look at Germany, Germany is yielding 0.69%. I say yielding, that's not yielding anything. If you lend your money to the German government, you will have to pay them 0.7% or 0.69% for the privilege of doing that. Same thing with Ireland, extraordinary. Ireland that basically was bankrupt in the last great financial crisis. You need to pay Ireland to borrow your money. And so it goes on. The list goes on and on and on. Paradoxically, but not surprisingly, the strongest economy globally, bar the Chinese obviously, is the US, and that yields 1.58% on the 10-year bond, which is way, way higher than anywhere else. But of course, that's the reason being that the economy is a lot stronger there, but still weakening. And that brings us on to the calendar. Let's just go through what's happening this week. We don't have anything on Monday. On Tuesday, we've got the Reserve Bank of Australia's monetary policy meeting minutes from their last meeting, where I don't think they did anything with rates there. It was the Reserve Bank of New Zealand that cut by 50 basis points. But really the first sort of key event, really, and it is the key event of the week, is on Wednesday evening, which is the minutes for the last Federal Open Market Committee meeting. That's the rate setting committee of the Federal Reserve. That's the US central bank, when they cut rates by 25 basis points. Be very interesting to get a little more insight into all that thinking. We know what Jerome Powell said in the press conference after the event, but that'll be keenly anticipated by the markets. 7 o'clock on Wednesday evening, and likely to move the dollar, definitely, bonds, definitely, and probably equities as well. So it could be quite an interesting time, 7 o'clock Wednesday evening. Thursday, we have services and manufacturing PMI data out of Europe. The one that everyone is going to be watching is the German flash manufacturing, in dire straits at the moment, way, way below 50, 43.1, so another slight fall. I mean, can it get any worse for Germany? As I said at the beginning of this piece, we had a negative GDP reading for Q2. Highly likely, when all is said and done at the end of Q3, which is the end of September, that Germany will post another negative GDP reading, which, two on the trot, it signals a recession, or a technical recession. Nothing quite as deep as what happened in 08-09, but still worrying for the Eurozone's strongest economy, which was the strongest economies. German flash, and so services data as well. When you look at the numbers across the whole board in the Eurozone, flash manufacturing and flash services both set to post slightly lower numbers from the previous month. And the notable thing is that services still remain well above that 50 level, but manufacturing in dire straits for the time being. And then we have flash manufacturing data in the States as well. Still managing to hold its head above 50, which means it's still expanding, but only slightly now in the US, as the numbers do start to cool there. There's talk in the Financial Times that it wouldn't just be interest rate moves. Trump has already sort of suggested there might be some sort of fiscal stimulus in the way of tax cuts and more spending. On Thursday, we also have the start of what's referred to as the Jackson Hole Symposium. It is the gathering of the world's central bankers in Wyoming at a place called Jackson Hole, so named because trackers that used to track around that part of the world, when they got into this part of the world, it's referred to as hole because it's quite difficult to get out of once you're in it. So Jackson Hole, but the central bankers won't have any problems with that. They've got corporate jets, haven't they? Anyway, that goes on for 3 days, culminating in with Jerome Powell, or Jay Powell, speaking at that event on Friday at 3 p.m. entitled Challenges for Monetary Policy. I'd say so. Golly, if ever there was something that the market's interested in, it's exactly that. The markets generally are really requiring a rate cut. They are trying to be as optimistic as possible, and that's the reason why stock markets are rebounding. Not because they're the economy in the US is growing sharply, or indeed anywhere else. It's more because in the hope that rates are going to be cut, and if rates are going to be cut, it's going to help businesses. But of course, yields on bonds, why would you put any money in bonds? You're not going to get any return on them at all. That's it, really, for this week. So central bankers, that's the theme of this week. Thanks very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.